Hi guys, this is Sam for Wealthwise. My background is I run multiple businesses. I have been in the industry for last 39 years. Started a few companies, sold off a few companies, and then currently running few organizations in terms of business lines like technology, healthcare, e-commerce, education, and real estate. So, welcome back. Today, we're going to talk about the similarity between the real estate market and then the stock market. So, I'll go through basically 6 points which talk about what are the similarities that are there between the real estate market and then the stock market. So, should you be investing in the real estate or should you be investing in the stock market, right? So, these 6 points form key criteria in terms of deciding what is better, right? I'm not a investment advisor, so you're free to make your own judgment. And I talk from my own experience of having invested and worked in the industry for last 39 years. So here we go, guys. So the first one is let's talk about real estate. In the real estate, there is first thing called the replacement cost. So whenever you're buying a building or you're buying a home or you're buying a condo or a warehouse or a shop, you're going to look at the replacement value. In the stock market, it is called the book value or the intrinsic value. So the book value is the net worth of the company in terms of assets, and the intrinsic value is the fundamental fair value or the perceived value of the company. So as long as you're buying a real estate below replacement cost and you're buying the company at book value or the intrinsic value, you have a very safe bet. Number two is the area where you are developing either the real estate, you will look at the sector. So the sector could be multifamily, it could be hospitals or hospitality, it could also be healthcare, or it could be warehouse or mixed use property. So that would be on the real estate side. On the stock side, you would be looking at sectors which are up and coming, like artificial intelligence, crypto, fintech, and health tech or genome technology. So those would be the upcoming area. So in real estate, we look at the areas which are getting developed or which are really coming up in terms of the sector. Similarly, in the stock, we looked at the upcoming area which are kind of going to come up or are on the verge of coming up and have all the ingredients to kind of uh, have the ecosystem around them, right? So, for example, if you need AI, you need chips, you need big storage space. Similarly, if you are developing a property, you need walkability score, you need schools, you need hospitals, you need markets, so on and so forth. So in the stock side, obviously, it has to have the ecosystem, it has to have the bandwidth, it has to have the storage space, it has to have computing power. So if you're looking at artificial intelligence, and if those infrastructure is in place, then both of these would be a good bet in order to invest. The third thing we are going to talk about is location. So just like there are places within US, Canada, China and India, as well as Australia and other countries which are doing extremely bad and the market is tanking down, but there are places which are doing extremely well, and hence location is extremely important for the real estate. Similarly, for the stock market, there might be a country which is emerging and upcoming in certain area like health or telecom sector. So the geography of the investment or the stock exchange would be very important, or the company would be very important. If it's a mining company, you would have to look at where there is demand for that metal, where the mining company is situated. Or if you are looking at the healthcare sector, then where is the population to kind of use that health. Similarly, location is extremely important both for the real estate and the stock market. The fourth thing is the carrying cost. So in a real estate scenario, you will be looking at taxes and the maintenance and break fixes. And while in the stock market or the index fund or mutual fund or the ETF or the options, right, you're going to look at the carrying cost, which is much lower than that of the real estate. Real estate typically would be 1.25% in terms of property tax, another 1.25% in terms of break, fix, and maintenance, or maybe higher. So to average cost of maintenance of real estate, what we call as carrying cost, would be 3%. Average carrying cost of a stock is just the broker fee, and in some time, if you're using an advisor, it would be less than 0.5%, 0.5. So clear winner is the stock market in terms of maintenance or carrying cost. So that's number 4. Number 5 is the returns. So let's assume you buy a real estate worth $1 million. So it would be like a 3-bedroom townhouse in US or Canada, and in China and India it would maybe $500,000 would be the real estate cost. Typically you would get for $1 million you would get around 4%, which is $40,000 return annually, or 5% if you're lucky, which is $50,000 annually. Now, if your carrying cost is 3%, your net return is around 2% on real estate. Whereas in the stock market, you would get dividends anywhere between 1 to 5%. If you invest even in REIT, you can get up to 3.5 or 5%. If you invest in an ETF, a lot of ETFs like DGROW, or SCHD, they give you a decent return. They give you, some of them give upward of 5%. SCHD gives 4%, very stable in terms of dividends. So it's kind of, in terms of return, I would say if I reduce the carrying cost, stocks come up a little bit ahead in terms of investment, right? So that's the 5th thing. The 6th is the capital appreciation. The capital appreciation, what we call as compounded annual growth rate, CAGR, in terms of real estate is in North America in the last 10 years has been 6 to 6.5%. Whereas in the stock market, if I look at NASDAQ, it's between 16 to 17%. If you look at New York Stock Exchange or the Dow, it's 9 to 10%. So clearly stocks come up ahead. Now, the 7th thing which we are going to talk about, the availability of liquidity of each one of this. So real estate typically would take some time, 3 to 6 months, even if you are in an urgency to sell, because that's the closing time of real estate, whereas the stock is instantly available cash to you. Whenever you want, you can sell it, right? The volatility is little higher in stock market compared to the real estate market because it's a physical asset. It takes time to go up and down. It doesn't fluctuate as much as the stock market. So those are the 7 criterias for which you can look at and decide what is the better fit for you based on the macroeconomics as well as the sector rotations and the industry sectors itself, or the way the economy is behaving. You can look at those aspects and decide what fits your best personal needs and make a wise choice. So hope you liked some of these tips and tricks that I gave you. So decide what's better for you, whether you want to go for the real estate or you want to go for the stock market. You can also rotate between these 2 sectors. I did this successfully, and my last video I pointed out how I did that. And there are opportunities in both the sectors, and timing them can be challenging, but if you are persistent and you do smart investment, I talked about the pyramid strategy in my last video, right? Those would help you in terms of scaling yourself and getting that multi-baggers that everybody is wanting to look at, right? So please do like and subscribe this channel. And this is Sam signing off for WealthWise, and talk to you in the next video. Thank you guys.